The best of Money Matters. Market View on Money FM 89.3.
That's right. You're listening to Money FM 89.3, and it's now time for Market View, where we take a look at how the Singapore stock market closed for today, the biggest movers, sectors, and companies to watch to help you better position your portfolios. I'm Alexandra Parada. The SCI closed down at 0.5% at 3,894 points. Starting with local movers, IHH Healthcare reported a 33% drop in first quarter net profit attributed to lower monetary gains and the lack of a one-off tax credit in Turkey. Over in the region, Japan's Tokyo CPI surged to 3.6% in May, its highest in 2 years, is adding pressure on the BOJ ahead of its next policy meeting. Meanwhile, Hyundai is weighing sweeping U.S. price hikes in response to new tariffs, with potential implications for inflation and consumer demand. And U.S. President Donald Trump is ramping up pressure on the Fed amid softer GDP data and ongoing trade tensions. Now, for more market moves and views, joining us today is Dan Chang, investment specialist and trading representative at PhillipCapital. Hi, Dan. Happy Friday, and welcome back to the show.
Hi, Alex. Happy Friday.
Happy Friday as well. So the SCI opened at 3,914 points today. What do you think moved markets? Any movers that surprised you?
Well, I think it's a bit of a bummer here. I mean, yesterday, right, news of the U.S. court blocking this Donald Trump's tariff move actually boosts a bit of optimism on global trade, only for the federal court to reinstate, that ruling. So a stock opening today is actually not unexpected. Mm-hmm. And one stock did catch my attention today. That was this Equifax Hospitality Trust. So it was announced just 45 minutes before the market opened that, they are possibly working with their sponsor on a potential transaction in light of some potential capital expenditure needed for the REITs in relation to some ongoing asset enhancement requirement of its existing portfolio. Mm-hmm. So, of course, as they always state, there's no certainty that this transaction will materialize, but the stock market seems to take it very positively. So, despite being under the radar for years, okay, the share price has actually surged more than 30% in the past month. And today, right, it rose even further to touch a 10-month high of 30 cents on heavier than usual volume. Mm-hmm. And, of course, I think a potential reason other than this announcement is, recently we see a lot of privatization in the Singapore hotel space. Mm-hmm. So I think definitely a stock to watch in the coming weeks.
Mm. Now, let's start with IHH Healthcare. It posted a 33% drop in its first quarter net profit, which is largely due to lower monetary gains and the absence of a one-off tax credit in Turkey. How do you read these numbers, and how's the market reacting? Do you think investors should be cautious or see this as a buying opportunity?
Yes, actually, this headline 33% drop in 1Q net profit, right, may be very concerning at first glance. But before we hit the panic button, I think we should peel back the layers a bit. Mm-hmm. So the decline, right, was mostly due to technical factors like a lower monetary gain from the application of these financial reporting standard. So it's more of an accounting thing. Okay, mm-hmm. And of course, as you mentioned, the absence of a one-off tax credit that they have enjoyed last year. Mm-hmm. If you strip out these two things, right, the core net profit actually rose by 5%, which I would say is a decent return now. Okay, and but it seems like the market is reacting very mutely to these whole news. As I was just checked, right, the share price was actually closed just up 1 cent at $2.10. There wasn't much movement throughout the whole day. And, I guess it's not a big surprise. And as to your question that should investor worry or not, I think not really, because healthcare demand remains strong across a lot of key markets. And, of course, the fundamentals are still in stable condition. Mm-hmm. At least that's what we can see for now. So long-term investors may want to just stay holding on to it and stay in the waiting room, so to speak.
Now, looking over at Japan, Tokyo just reported its CPI rose 3.6% in May, its highest reading in nearly 2 years. Now, with food prices continuing to climb and even wage pressures building, how likely is it that the BOJ pulls the trigger on a rate hike as soon as July?
Well, it seems to me like they already have their fingers on the trigger point already, but not quite really squeezing it just yet. I mean, inflation is what was reported, right? Inflation is clearly on track above 2% for the 3 straight years now. But with a possible summer election and, some fragile household sentiment and tariff tension that is happening right now with the U.S., I think the Japanese Central Bank, BOJ, may just want to hold fire in June, at least for the next month, and wait for more clarity. I mean, wage pressure, tight labour market, they are actually keeping the BOJ on very close monitor. Well, I mean, not on the table yet, but we definitely will not rule that out further down the road.
But do you think that the move by the BOJ will have spillover effects on other Asian markets like Singapore? Or is this more of a Japan-specific inflation story?
Yes. So if, in a hypothetical, if the trigger is indeed pulled, right, the yen and possibly most Asian market might feel the tremors. Okay. I mean, Japan's inflation story is largely homegrown. I mean, that is not deniable. But we simply can't rule out some of ripples that they can have on the Asian market. I mean, a rate hike could, niche the yen higher and shake up the yen carry trade and may even trigger some capital rotation within the Asian market. So I think the more important question is how big would this ripple be rather than whether they will have an effect or not. So that will really depend on how aggressive the rate hike is.
I see. And we're also seeing big developments in the auto space as Hyundai is weighing sweeping U.S. price hikes in response to tariffs. Now, they may raise sticker prices and fees across the board. How serious do you think this is for U.S. consumers? And what might it signal for broader trade tensions, inflation risks, and even market sentiment?
Well, I guess even Hyundai cannot escape the cross of Trump's tariff policy after all. And as many of us may be aware, tariffs are usually passed on to the consumer. Hyundai doing this is just its way of, dodging some of these tariff pain. So zooming out, right, this isn't just about Hyundai itself. I think it's a flashing sign that it's a flashing warning for broader trade tension and inflation. I mean, if more car makers were to follow suit, right, it could add fuel to this inflation fire, and I'm sure market will not like it in this way. Yeah.
Now, over in the U.S., GDP came in weaker than expected as it revised down to 0.2%. And this comes as markets juggle mixed economic data, tariffs, and even election year rhetoric. What's your take on how all of this is feeding into investor sentiment globally? And how should markets be positioned in this environment?
Well, it is not exactly the kind of economic growth that you want on the campaign poster. So definitely not what the mega voters have signed up for when they vote for Donald Trump as the U.S. president. Well, I mean, consumer spending hit the brakes. Trade took a bigger bite than expected thanks to all these pre-tariff import surge. So for investors, right, as you might know, right, I think it's a cocktail of confusion. One part there's weak data, one part there is tariff turbulence, and of course there's also this election year drama. So if you shake this cocktail well, right, you got a market sentiment that is on the rock, somewhere uncertain, a lot of confusion here. And I think this confusion, right, this is adding jitters not only just to Wall Street, but it's also spilling over all to Asia markets. I mean, if the world's biggest economy is stalling, right, it's no surprise that risk appetite may just pull back across the global market.
Now, meanwhile, Trump is making headlines once more because he is ramping up pressure on the Fed to cut rates again. He's calling the current policy too tight and even blaming the Fed for holding back growth. How much influence do you think this rhetoric really has, especially with inflation data still sticky? Well,
Trump is turning up the heat again on the Fed. It's not the first time and unlikely to be the last time. But, it's classic Trump's, part persuasion, part pressure, but all politics. But based on what we have seen thus far, right, Fed Chair Powell is not easily swayed by all these, White House vibes. Okay, and the reps are playing the long game, still watching the sticky inflation data like a hawk. So I guess until price pressure really cool meaningfully, right, we are not expecting a rate cut, partly just because Donald Trump says so. So still, that's it, right, we have to understand that the stock market, other than being a value barometer, right, is very much ruled by sentiment as well. So market may have just priced in more political risk around these Fed independence, which can move the bond yields or even shake confidence in the policy outlook. So ultimately, right, I mean, in Powell's campus, it's all data and, not White House drama. Yeah.
But with the Fed watching the upcoming PCE data closely, what's your take on how they're likely to respond? Are markets still betting on a cut this year, or are we entering another round of higher for longer scenario?
Yes, actually, personally, I'm also waiting for the PCE print as well. I mean, the PCE is the Fed's favorite inflation gauge. If it comes too hot, you can bet that a higher for longer crowd may just get louder. And if you get signs of cooling, right, the door to a rate cut may just crack open a bit. But overall, right, I think the market are still flirting with the idea of these one cut this year.
Okay.
So it's unlikely to be the summer. Maybe, I would say a December holiday special, if you want to put it that way. Definitely the Fed is in a wait-and-see mode.
And before I let you go, Dan, anything else that caught your attention? What's on your radar in the coming days ahead?
Yeah, other than the Ecoflight Hospitality Trust that I mentioned earlier, right? One stock that I'm watching is this small mid-cap called Centurion Corporation. So what happened was that a few months ago, they have previously stated that they are exploring a spin-off of their UK student housing business, those purpose-built student accommodation, into a REIT and possibly listing it right here on SGX. Okay. Another reason why I'm watching it is that I've been reading a lot of analyst report, and a lot of analysts are buzzing about this Centurion being a potential beneficiary of the MAS 5 billion equity market development program. So, of course, I mean, all these are still very much in the crystal ball stage, so we shall see how it goes lah. I mean, that's it, right? Do note that, the share price has appreciated more than 40% since the turn of the year, so it's actually on higher ground now. Naturally, the risk tolerance on this stock would also need to be relatively higher. Okay. And last thing for disclaimer, this is not a stock recommendation. It's simply just sharing my thoughts. Yeah.
Okay. Well, thank you so much for joining me today, Dan.
Thank you, Alex. Thanks for having me.
That was Dan Chang, investment specialist and trading representative at PhillipCapital. This has been Market View on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.